I think we should start with the jobs numbers out on Friday in the United States. I mean, some say not too hot, not too cold. Some people say, isn't this good? At least it's not getting worse. I guess my real question to you is, it may not be getting worse, but is there a danger just in the inflation remaining where it is? We have 5% year-over-year increase in wages.
I think these numbers were about what we expected, and the sensible judgment was that we've got an inflation problem. Core inflation figures look artificially good. They're better than median inflation, and yet core inflation ran at a 7% rate last month, and that was more than for the quarter. And the quarter was more than for the half year, and the half year was more than for the whole year. So we're not in a controlled place with respect to inflation. And there wasn't really anything in this report to suggest that we were coming into a controlled place. The monthly wage number was relatively favorable, but it was pretty clearly distorted by the fact that you had a lot more workers coming in leisure and hospitality, and those are low-wage workers. The workers where wages are most flexible are going up more rapidly. So I don't think this is a number that changed the picture, that we've got an economy that is too strong to be an economy where inflation is going down, but that is maintaining its robustness. But I think we are headed for a collision of some kind or other, and we've just got to manage that collision carefully. And I think the sooner we start managing for some slowdown, the better we're going to do. I think Chairman Powell was way late to come to that recognition, but he now has that recognition, and he should be supported in that.
So what do you think Chair Powell and the Federal Reserve will make of these numbers? How will it affect what they do in early November?
I don't think these numbers are going to change what the Fed does. You know, you never know what's going to happen, and certainly there's risk of some kind of financially traumatic event, but I think the chances of something that is large enough to divert the Fed are really quite low. So I'd be expecting that the market, which is anticipating 75 basis points in November and is anticipating 50 more in December, that would correspond to my best guess at this moment as well. And I think that kind of thing is going to be appropriate if we achieve disinflation.
Larry, there's another strain of discussion I've seen certainly this week. In fact, there was even some Fed staff work at the New York Fed suggesting that we better be careful because, in fact, the rate that we may need in order to get down to 2% may be so high it will cause financial instability. There is really a safety and soundness issue. What do you make of that? Is it possible the Fed will have to choose between financial stability on the one hand and getting inflation down on the other?
First, I think that should be the occasion for some soul searching. If we have an economy where we think there's going to be substantial financial breakage because the Fed lifts the Fed funds rate to 4.5%, then we have an inadequately supervised financial system and an insufficiently active financial regulator. And so if anyone believes that, along with whatever monetary policy implication they draw, they'd better tell us how they think we ought to be repairing the regulation of the financial system. David, my sense is that you can never rule out these kinds of risks. But the Fed has more than one instrument. It has instruments for specific guaranteed lending. We've seen that used a number of times, and each time we're surprised by how much the economy retains its robustness. In retrospect, we cut interest rates too much and kept them too low when we were supporting the financial system after COVID. In retrospect, we kept interest rates too low and blew up a bubble when we were supporting the economy with low interest rates after Asia and LTCM. In retrospect, we were surprised, amazed by how rapidly the economy grew when the Fed did what was necessary after the 1987 stock market crash. So we need to regulate right to preserve financial stability. We need to have a very strong firefighting force in order to respond if and when financial accidents happen. But I think it's a real mistake to suggest that somehow we shouldn't do the monetary policies that are necessary to avoid inflation becoming entrenched because of concerns about financial stability. You know, David, the people who are still on team transitory, they're always saying that expectations aren't entrenched. The more it's true that expectations are not yet entrenched, despite high inflation, it seems to me the more important it is to move vigorously now with respect to inflation so they don't become entrenched. If they were already entrenched, we could discuss the right timing of a disinflation. But if we have the big advantage in disinflation of expectations that are not yet entrenched, surely we should be acting on inflation while we have that advantage.
Larry, another big development this week was the OPEC Plus decision to reduce production limits by 2 million barrels a day, something that I think it's fair to say set the Biden administration back a bit. He'd gone over there and asked the Crown Prince not to do that. It wasn't very pretty. So apart from perhaps any embarrassment of my cause, does it have larger macroeconomic effects for a globe that we are warned by WTO now may be headed toward a global recession?
There's nothing good in this. Certainly it's not what we wanted to see. Actually, it's a lot less than 2 million barrels because many of the countries that reduced their quota weren't hitting their quota before, so the reduction in the ceiling didn't really matter. And you didn't see a hugely dramatic move in oil markets in a way that was proportionate to the headlines that you saw. But certainly the risks are up, and it just points up the importance. And we always do a scramble about the immediate when these things happen, and we don't forget about the medium term. Look, we made a mistake by canceling the Keystone Pipeline. We made a mistake by slowing down all kinds of permitting activity. We made a mistake by being hostile as a country to natural gas. We made a mistake in the Congress a few weeks ago when we didn't pass the Manchin program of expanding permitting. We crucially need regulatory relief, or we're not going to get renewables online fast, and we're not going to get the transmission lines that are necessary for renewables to become a large part of our energy fast. So the real lesson on this is we need a different kind of energy strategy than the one that we've had. We need a strategy that is balanced rather than an unbalanced strategy of total hostility to fossil fuels, or God knows the kind of total strategy of favoring fossil fuels that we had, and even egregious favoritism towards Saudi Arabia that we saw during the Trump administration. We need to find a balance, and I think we're making our way in that direction.